Hey guys, Magnus Best Test here. So let's talk about Bollinger Bands. Bollinger Bands, here we have them also on pocket option, of course. Let me put them right on the chart. Bollinger Bands, there you go. So they are basically designed on moving averages. So let me show you the wise and smart Investopedia website. Here they talk nicely about it. I'll just try to make it very easy to understand. Created by John Bollinger, and basically by default it uses 20-day simple moving average. This is the middle line by default, but of course here by default we don't have 20. Let's check what we have on pocket option by default. It's 5, so let's put it on 20, and then alright, let's continue reading. And it uses 2 standard deviations by default. So let's do that here as well. Let's use 2. Now we are ready, as it should be by default, as designed by John Bollinger. Here we go. So how to trade it? Let me just first explain a little bit more, but basically this, at the beginning I will say that there are also other channels, and I will explain them just in a few minutes, and they differ in the way how they should be treated. So Bollinger Bands, and also how they are created. So of course, so Bollinger Bands, they are basically a reverse trading within the bands. So you are supposed to actually, when you are on the top level, it should be considered as overbought. So you should be basically selling. And here, if you are at the bottom, you should be basically buying. This is the purpose. And how it is created? Again, it uses those 2 standard deviations, but what does it mean? So let me just go quickly and show you there's actually a formula. So it's not just adding, because this is, I will just make it clear, this is the 20 moving average, this line in the middle. And just to show you, just to prove it, here you have my indicator. This is, let's put it on 20. And here you see it's the same, visible, not visible. This is the indicator. This is the Bollinger Bands, because the indicator is invisible, but moving average is invisible. So this is just the moving Bollinger Bands line, you see, and it's the same as moving average 20. So now you understand this is really the line of moving average. And let's see, how can we get these lines? Is it just like 40 and 10? No, it's not. Basically, it works a little bit more, it's a little bit more complicated, but not that much, and I will quickly explain it to you. So it's not just, so this is the formula. You can just stop the screen, the video, and have a little reading over here. This is for BOLU, bull. It's the upper band, this is the lower band, of course. Very simple equation. Here it's explained what every of these letters mean. And so here we go, the moving average, let's say it's 20 as default, and here is the trick. So basically it's not just when we use the 2 standard deviation, it's not just, this is M, this is like 2 times, so this is the standard deviation. As you can see, number of standard deviations. This is the, okay, let me close, no, let me quit Telegram, and let's continue. So it's 2 times, and 2 times what? It's not 2 times the moving average, like simple moving, because I need to backtrack a little bit. The moving average, it measures the closing prices normally, the closing prices. So here we go, and so this is the 20 moving average, and it's the average of 20 bars back, and we also count the first candle as well, including this candle, 20 back, and here you can see the average of these 20 candles, but closed prices, okay? And these upper and lower lines, they are not just closed prices, like average of closed prices, but they are actually average. They are basically calculated averages of not just closing prices, but high plus low plus close and divided by 3, so the average, so that you can get the average. Basically, Bollinger Bands is based on the variance, so how much the price goes away from the average, up and also down. So basically, standard deviation is mathematical measurement of a average variance and features prominently in statistics, economics, blah blah. Okay, it's we here emphasize we want to know like how much it differs from the average. So the way how we get it is also taking into account the high and low and the close, and then we use the average. So here we go to the chart, and you can nicely see what I'm talking about over here. So to make you understand it now completely, it's not about doubling the moving average period, because it's always the same period. It's 20. Okay, it's just what you take into account when it comes to the candle. So Bollinger Bands, it takes into account in these upper bands and lower bands, it takes into account, as I said, the high and the low and close of the candle. And to show you even more how it looks when you compare it to the real highs, just highs or just lows, I will use the next channel I want to talk about, and that is Donchian channel. And the reason why is because Donchian channel actually takes into account not only the moving average. So basically, let me put the same moving average for the middle line, so that we don't have a million lines over here. Okay, it is the same. Wait, this one is what? So it's 20. This one is okay. Let's put it 20. Okay. So now we get. Let me just show you Donchian channel. And actually, the easiest way how I can explain to you the Donchian channel, how it takes into account the average price of high and low. To prove it to you, I will just I need to do it on TradingView, because on pocket option you cannot use moving average less than 2, the period less than 5. So here I need to find Donchian channel. Here we go, Donchian channels, and let me put it to 1, length 1. There we go. Let's take, for example, this candle, this black candle, bearish, and let's go calculate some stuff. So I will look at this, the high and the low, the highest low and the lowest low. So basically high and low, okay, of this candle. So let's go. 1754 is the high. Now plus the low, so 14.678. And now what we do, we just divide by 2. We want the average, and that's 184.716. And is it true? Let's go if this middle line is really, so this middle line is the period 1, okay? So if is it 184 point, and as you can see, correct to the point, to the cent. Basically, now you can see the explanation in the best form. This is how the Donchian channels calculate the middle line. Okay, so and then of course this is just for the moving for the period of one. So if it's the average of the running candle of the first candle. But if we use like the moving average, like the period 20 for example, it will be simply the average of highs and lows of last 20 bars, 20 candles. Okay, so from here and here, okay, the high. So that's it. Let me go back to pocket option. So hopefully you get it now. This is just the Donchian channel. Here now we have it on 5. This is the minimum. I put 1. It just doesn't work. You see, switches to 5. So let's put it to 20. Something normal. And what I wanted to now explain why I started to talk about Donchian channels. This is a smooth transition actually, but I will go back to the Bollinger Bands just a little bit because I wanted to show you that this lower band on Bollinger Bands, so basically you see this yellowish, this is Bollinger Bands, visible, invisible, you can see, so don't get confused here, stay on track. This is the Bollinger Band, and why doesn't it go as low as this Donchian channel band, the band on the lower side. Why? It's simply because the Donchian channel takes into account the low, the highs and the lows. So basically, this is the difference. As you can see, the Bollinger Bands are smoother. They just calculate it goes on the standard deviation of moving average 20. So in this case, it's 2. And so basically, the difference between the Donchian channels and the Bollinger Bands, when you look at the bands, let me switch to pocket option, is that the Donchian channels take into account, they are basically not derived from the standard deviation, it just takes into account the lows and highs. Okay, so basically that's why the way how you trade it with Donchian channels, this is supposed to be a continuation or trending strategy. Whereas when you use Bollinger Bands, it's a reversal strategy. So as I explained at the beginning, with Bollinger Bands, the price goes up like this. Let me just, this is the Bollinger Bands. Okay, those greenish, yellowish. The price goes to the top, and then when it's rejected, you can basically trade downwards. But so basically, because this is the reversal indicator, it shows you that it's already overbought. But with Donchian channels, it actually shows you where was the high in this case, for example, or let's show this low. Where was the low over the last 20 candles, or which period we have set up? Now we have 20. So where was the low over the last 20 candles? And once it breaks, it can very much mean that we are actually breaking down to new levels, to lower levels. It's like the breakout strategy, okay? So because it's very probable that if we break lows of last 20 candles, probably we can go down even more, okay? So this is the difference. And now let's talk about Keltner channels. So basically, let's add it first. Where do we have it? Keltner. Okay. Where is it? Oh, okay, I'm looking. So now we have really a messy chart. So let me just turn. Wait, this is in the middle. The blue in the middle is Keltner. Okay, don't worry. I will turn off the other charts. But just for now, you can. Let me put the period also. It's 20. Okay, but no, it's EMA. Okay. So here you can, I actually want to explain later, but here you can see that in comparison to the Donchian channels, the the Keltner channel uses ATR, so average true range, which I was explaining in my previous video. Actually, it's basically a average of the range of a candle, so of the length of a candle, and depending on which period you set. So for example, if you have set the average true range to 10, it's the average range of last 10 candles, including the current candle. Okay, guys, here you can see also a multiplier and EMA period. So let's leave it like this. EMA is a little bit different than simple moving average, but more or less, because EMA, it takes into account. Now let me quickly explain to you what's the difference between SMA and EMA, simple moving average and exponential moving average. So basically, the exponential moving average, or let's just start with the simple moving average, as the Investopedia website says, the simple moving average assigns equal weight to all values. So basically, it's always just the average of the, let's say, 20 last candles. But the EMA, it puts more value on the most recent action. So basically, here the example. So basically, let's just, the weighting given to the most recent price is greater for a shorter period of EMA than for a longer period EMA. For example, an 18.18% multiplier is applied to the most recent price data for a 10 period EMA, while the weight is only 9.52% for a 20 period EMA. So there you go. As longer EMA you have, longer period EMA you have, the less weight is applied to the recent candles. Okay, so I'll just go back to the pocket option. Here we have Keltner channel, and here we have the EMA. It's 20. As you can see, this is the simple moving average 20, and this is the EMA 20. So it's a little bit different, but it's similar. Okay. And as you can see, it goes here, for example, lower, because there was the price action here was dipped more. So the move was stronger here recently. So it just shows the recent move more exaggerated than the normal moving average, which is this line. I hope it makes sense, this line. This was Turkish. I don't know. Okay, so let's just turn off now these other channels. Now you can see just the Keltner channel. So not only does it take into account it has like EMA and different it's not simple moving average, is EMA, but also it takes into consideration the ATR. So this is the big difference when you compare it to Donchian channel, because both are traded the same. It's the breakout, it's the continuation pattern. So here we have the lows, and basically you are supposed to continue the move. So when you see something like this, it breaks, you are supposed to go down. When it breaks the lower band, you are supposed to go down on the Keltner channel. Okay, don't forget, now we are talking about Keltner channel, and it's the same continuation strategy as Donchian channel, but it takes into consideration average true range. Okay, and the difference, of course, between the Bollinger Bands. Bollinger Bands are traded as a reversal. Okay, and also, of course, we are using standard deviations for those upper and lower bands. It's not highs and lows. Okay, hopefully that makes sense. And actually, I want to complicate it a little bit more. We have another channel in the indicator selection, and so just let me first, so John Bollinger, he was the creator of Bollinger Bands. Then you have, what was it, Richard Donchian. Let me check it. For Donchian, Richard Donchian, yeah. And then we have Keltner Channels, and the inventor was, here it's Chester W. Keltner, then later modified by Linda B. Harashka. Okay, and now let's go to our last channel, and this is Stoller Average Range Channel, STARC Bands. Okay, and so what this time we are again doing reversals, so it's similar trading style as the Bollinger Bands. And here I need to just show that to you only on the website, because Pocket Option doesn't have this indicator in their selections. So here we can see, let me just read it for you here as well. You can read it. Basically, when we are at the top, touching the top, it means we are about to be in a low risk position for sell. So we should be basically selling. And then we are at the bottom band. We are about to be at a low risk position for buys, as it says here. Price that declines to the lower band, low risk buy. And of course, it would be risky to go sell. Okay. And the bands, how they are calculated, it's pretty much similar to the Keltner Channels. It takes into consideration the market volatility, so average true range as well. Here you can see it as well, return. But you trade it not like Donchian or Keltner Channel, but you trade it more like Bollinger Bands, so reversals. Okay, so this STARC Bands you trade as reversals. So guys, that's it. I don't want to complicate it anymore. Here we have all those. I'll just sum up. I'll put all of those on the chart. And here I can see this is the Bollinger. All of them have 20, okay, moving average period. So this is the Bollinger Bands. It uses standard deviation. In this case, by default, is 2. So this is what I use. Standard deviation for the upper and lower bands. Then here we have Donchian Channel. It uses the average prices for highs and lows. So it's a breakout strategy, because we are breaking highs or lows for the last 20 candles here, if we have the period for 20. And here Keltner Channels, similar, we are also trading the breakouts, but in this case also the bands, the upper and lower band, take into consideration average true range of the candles. Okay, and it's this one in the middle. So hopefully it makes sense, all those differences. And I need to say the most important thing is that actually I don't trade using these indicators because I don't think it's a good idea. And as you can see on my channel, I trade just one strategy for pocket option, and that is a breakout strategy that I developed over the years using all my knowledge from basically all my studies and testings and programming, blah blah blah. A lot of years of long hours of study trading and everything. Here the problem with these bands is that you actually never know how long it's gonna continue. For example, let's now talk about the Bollinger Bands. Okay, so it should be reversal. But look, do you really want to reverse here? Like you, okay, you can have like confirmations, but many people just reverse here, and look, it just continues even down. Okay, you will get stopped out even if you think like, okay, I have a confirmation candle, like it closes above this red candle, so you think like, okay, we have confirmation, we are on the lower band, let's go up. But no, a stop loss below the low, and no, you got just stopped out, so here you can see prime example that this is not a good strategy. It works sometimes and sometimes it doesn't, and this is the reason why everybody is failing at trading. Here, let's look at Donchian Channels. So as I said, this is the breakout strategy. You are supposed to be trading on the breakout. So here, basically it breaks. Okay, you are successful here. Let's go. We are. And also, of course, this can be like very ambiguous, like because sometimes it's just like you actually don't even know if it breaks. And the strategy description normally says like it should be closed candle, so you should be basically starting to trade only here. And if you did that, you would be in loss because it reversed here. So if you would follow the strategy for Donchian Channels, you would open a trade here. We are continuing this downtrend. The candle closed, and look, you got stopped out. And of course, the breaks without candle closes are even more risky. Here it might have worked, but in other cases, not so much. Okay, then here, and then it depends on you, like how long ranges you wanna. And like breaks of how long ranges you want to trade. Maybe this is like too a low range, but let's say, what do we have here? Maybe this break, no, it didn't close, but it would be a fake out. It looks nice sometimes on when you just go back, in the history, but in the real life situation, like when you don't see what's coming, it's not so clear anymore, and that's why it's just more and more confusing for traders. They just get caught in all this indicator game, new channel, new indicators combination. They just start to make maybe 20 is not a good number. They would try to maybe choose their lucky 27 number. I don't know, maybe they have lucky number 29, and they will basically, it can be infinite combinations, if you know what I mean. So the indicator, and of course I know what you are saying now, like combination of other indicators, and this is a maybe solution for the lack of qualities of one indicator, but still you can combine it as here, for example. Okay, you can combine, what was it, this, they recommend combining the last indicator, where was it, with the STARC Bands indicator with stochastics, like here, and here it looks nice. Stochastics points down, here reverse points down, but it also doesn't work always. It just sometimes works, sometimes it doesn't. Sometimes it just goes, the price to the touches the band, sometimes just close, like almost touches, and you just never know, like, is it enough or is it too much or is it now breaking? Like, there's infinite amount of combinations because charts are random, and this is where you find out that you are basically a losing trader if you trade using these indicators. Okay,